Okay, this step is, or can be, fun, actually. It's quite fun and very rewarding to see it happening. And I actually had, I wouldn't say like a bad attitude, but I guess maybe kind of a bad attitude towards interest. I was just like on an interest attack mode. I'm like, no, this is crazy. How much we're paying in interest for this or that? And it was just like, no, 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 no. So we took the approach, and it may not be the right approach for you. There's two approaches, and I'm going to cover them both, but I just wanted to tell you that I was more focused on saving more money because we didn't have very much money. So like every bit saved was important to us. So we took the approach of attacking the credit that had the highest interest rate, not the highest balance. And that is the other approach. And so what you want to do is you want to list, and we'll have another sheet for you down there. So you'll want to list all your creditors, credit cards, student loans, list them and find out what the interest rate is on them and list that next to it and put your balance, get your balance on there, and your minimum monthly payment that you've been making to each of them. So you want to write that down in there, okay? From there, like I said, what we did was attack the one with the highest interest. So the money that we were putting into our $1,000 fund, emergency fund, that money that we were putting in there every month, whether it be $40 or $100 or $400, whatever the case is, you want to continue to have that amount. Just keep doing exactly like you're doing. But what you're going to do is you're still going to make the normal payment that you were making to that account. And I'm talking about the account that you're attacking. If it's the one with the lowest balance, then you're going to start knocking them off faster, obviously, and you'll see more instant gratification because you're going to start going, whew, that one's gone, that one's gone, that one's gone. Whereas the ones with a higher interest may have a higher balance on it, or it may not. It just kind of depends on where you're at. So what you're going to do is you're going to totally attack that one account. You're going to pay the minimum balance on all of the rest of your credit cards, and you're going to take the amount that you were putting into your $1,000 emergency fund, and you're going to attack that one account. So you're just focused on paying off that one account until that is gone. Now, if it is your highest interest card or loan, then what you'll want to do is probably close the account once you have it paid off, as long as there's no penalties. And I highly recommend closing any credit line or source that has an annual charge to it. It's fine to keep credit lines open, and keep a zero balance on them so long as you don't have an annual charge on them, because there's no reason to be paying something. You do want to have credit, so it is kind of good to keep lines open. We're not going to encourage you to just totally close all of them unless you are totally out of control and you can't control your finances. Then it would be a good idea to go ahead and close all credit lines. So what you're going to do is begin to eliminate your debt sources. So let's say you have now completed paying off loan or credit card number 1. That was on your list. And how did you do it? You did it using the money that you were putting into your $1,000 fund plus the minimum payment that you were already making. So you just continue to make the minimum payment on it plus what you were putting in there monthly. But now that that card is gone and it's paid off, what you're going to do is move on to number 2. And guess what happens? Yes, you guessed it, didn't you? You're going to take the money that you were putting into your $1,000 fund and the minimum payment that you were making on that other card. Add those together. Now that's the extra that you're paying in towards card number 2 or loan number 2, or if it's an auto loan, whatever it is. So now you're working on number 2. And you're just doing the same, you're living the same way, you're doing the same thing. You're just working on one at a time instead of spreading yourself thin, trying to bring them all down. Oh, very important. I forgot to mention, one of the most important things is that you do not use the credit cards. anymore. As soon as you start the program, you should not be charging any more onto credit cards. You should be using only debit cards or cash. Okay, so basically if you can't afford it, then you just can't have it. If there's an emergency, that's why we're building your emergency fund, so that you can get things in an emergency, okay? So you're going to continue to work down the list from, you know, however you want, the highest interest or the lowest balance. You know, we'll start knocking those things off pretty quick. Either way, you just continue, the same way that you've been doing it. And if you continue that and you suspense all activity on your cards and do not charge anymore, you have no choice but to be debt-free. And all that interest that you would pay, just think about handing, you know, 10%, some people even more. Just take 10% of your income and give it away every month, because that's what you're doing. So not only are you saving the money that you're having to pay, but you're saving the interest. So things are going to start looking up for you. I promise you that. And when you are debt-free, it is a really good feeling to not have to make those car notes, not have to make those credit cards payments, and to not have to pay the interest that is associated with any of your accounts. So you're on your way. If you've made it this far, congratulations to you. I just can't wait to see you and how many people are able to, with a snowball effect, get themselves in a better situation by becoming debt-free. See you on the next step.